Sorry, starting again. Welcome to the StockRank Styles webinar. I hope that everybody can hear me. If you can't hear me, please let me know as soon as possible. This is going to be about a 40-minute webinar with hopefully some time for Q&A at the end. I will be running over what we call the StockRank Styles, which is a feature actually in development, but something you can apply immediately when you're using the site in interpreting the stock ranks. This is designed really as a webinar for subscribers to get the most out of the site. I will be giving a quick recap on what stock ranks are, but it'll be very brief. If you don't know what the stock ranks are, please do go and watch some of the previous webinars. Okay, I'm going to kick straight on, and 1 minute. And quickly, before we start, I must make the disclaimer. We are obviously a financial information site. We give you as much insights for your own investing as possible through all the work we do statistically on the site. Ultimately, it is a DIY site. Please do your own research. And nothing in this webinar is investment advice. So please bear that in mind, and we'll kick straight on. Okay, on the agenda today, I will give a very brief recap of what the stock ranks are. I will talk a little bit about what the stock rank styles are, because they may not be completely obvious to some of you. We will go into some rules of thumb for interpreting the stock ranks, and then I'm going to go into each of the styles in a little bit more detail with a bit more of an emphasis on what we call the winning styles, and there'll be Q&A at the end. If you don't know me, I am Ed Croft. I'm co-founder of Stockopedia.com. I used to be a stockbroker way back, but now I'm very much just a coding geek and a very motivated private investor. And Stockopedia has grown and grown and grown out of this enthusiasm. And you know, I hope that it's still proving very profitable for everyone that's using it. So I'm going to be your host for the next sort of hour or so, and hopefully introduce you to some really great ideas. So first of all, quick stock rank recap. What are the stock ranks? Well, obviously, if you are a subscriber, you'll know that we publish stock reports on every stock in the market, whether it's the UK or if you're an international subscriber, it could be an international stock in America or Asia or wherever. Here's a quick snapshot of a Facebook page. Up in the top right corner here, you can see a little box with the stock ranks in it. We have a quality rank, a value rank, and a momentum rank, which scores every stock from 0 to 100 across these three dimensions. And we blend them overall to create what we call the overall QVM stock rank. So if I start talking about Q or V or M in this webinar, please understand it relates to quality, value, or momentum. And once again, we score them so 100 is best and 0 is worst. So a low rank is poor for a stock. So as you can see, Facebook here has a very high momentum rank, very high quality rank, but quite a low value rank. In other words, it's expensive, but it's very high quality and high momentum. So this is a quick summary, a little Venn diagram, which I use sometimes to explain these ideas. And once again, it's just emphasizing the quality rank, value rank, and momentum rank. Now, these are not just metrics we've made up. They are founded in factor investing theory. And the theory of investing and the history of investing shows that quality stocks tend to beat junk stocks. And what I mean by that is highly profitable shares tend to beat shares in the market which are unprofitable. No great rocket science there, and it's pretty much as you'd assume. Similarly, value investing works. It's how Ben Graham and Warren Buffett and everyone in the value investing field got rich. And the simple rule behind it is that cheap stocks, on average, tend to outperform in the market expensive shares. And lastly, momentum, which is the factor which most people are very uncomfortable with in the stock market, but is one of the most powerful forces driving stocks. It's arguably an even more powerful force in the market than value, which is essentially that shares that have been rising continue to rise stronger than the market, whereas shares that have been falling tend to keep underperforming. And this effect tends to persist over 6 to 12 months. So these three forces in tandem create a very, very powerful triad, which impacts groups of shares in the market. And this is really what we're going to be talking about for the next 40 minutes or so. So very quickly, Couple of people saying, oh, it's okay now. I thought someone had some sound issues, but it might well be your own connection if you have sound issues. We do have a pretty good connection here, so if it cuts out, be patient, the sound will come back. Okay, what are the StockRank styles? We've done a little 14-page guide, which you can download at this link. Everybody on this webinar, I will send you these slides after this presentation. So you will get these links at the bottom of these pages. But if you go to stk.pe/StockRank-style-guide, you can actually download this guide, which is you can print out as a PDF and use it for reference. If you came to the show a couple of weeks ago, you might have got a hard copy of this. And this is a really good overview of everything we're talking about in a nice sort of glossy presentation. Really, the StockRank styles, if you think about it, these three forces, QVM, quality, value, momentum, they can pair up in different ways. Actually, if you take these three ranks, you can see that, bear with me, quality can be high or low, value can be high or low, momentum can be high or low. And there are 8 different combinations of these 3 factors if you take them to the extremes. And essentially, they create this grid, which I sort of joke in the office, this is a bit like the I Ching for the stock market, which really shows you all the possible combinations of their sort of binary combinations of these different 3 ranks. Now, these create archetypes of stock, which I'm going to go into a lot more detail. Above this central line in the green zone up here, you can see what we classify as the 4 winning styles of shares. Below the line in the red zone are the 4 losing styles of shares. And I'll be explaining how these losing styles of shares are tremendously attractive to investors, but tend on average not to pay off. Funnily enough, the winning styles of shares have a tendency to be less attractive to investors, but do tend to outperform. As you can see, the winning styles of shares tend to have either 2 or 3 of these factors quite positive, whereas the losing shares tend to have 1 or less positive factors. So just to interpret these little graphs, they're little mnemonics. So a long green bar shows a high rank. So this one in the super stock section shows a high quality rank, a high value rank, and a high momentum rank. Whereas at the other extreme in the sucker stock area, which we call sucker stocks, low quality, low value, low momentum. So, and you get all these other combinations. So for example, a contrarian share, which a lot of people is intuitive to a lot of people, is a good quality, good value share, but is suffering from some short-term poor momentum. And this grid of 8 styles, I want to help you understand and see and be able to spot on stock reports when you're using Stockopedia, because I use these as rules of thumb. Now, that leads me straight on to this point. At the moment, our style categorization is an art rather than a science. I tend to look at a stock report and I'll look at these kind of ranks, quality of 88, value of 72, momentum of 45. And in my own mind, I'll instantly think that's a contrarian share. It's got a low momentum rank and it's got quite strong quality and value ranks. In other words, it's a good, cheap, but pretty weak share. But we will be labeling stock reports with these style classifications from next year at the latest. It's a bit of an ongoing project here, and we're sort of discussing how many shares should fall into each category when we label them. But personally, I would love it if I had a classification of the style of a stock right there at the top of a stock report. So, but of course, there's a lot of shares which are what we might call style neutral or style agnostic. They don't necessarily fall into one of these into the hard lines of one of these buckets, and that's a bit of a sort of no man's land area where you might find pretty average stock market returns. So moving on from that, I tend to use in my own decision making some rules of thumb. My rules of thumb generally are I will seek 2 or 3 strong factors before a purchase consideration. So I will be looking for and I'm not, but I must make it clear that one point, because a lot of people who use Stockopedia, they just use the stock rank solely, but there can be some very, very, very good shares in the market with much lower stock ranks, overall stock ranks, which have a pair of very good, strong factors. So, for example, you often find that what we'll look at high flyers. High flyers often have lower stock ranks, but they have very, very strong quality and momentum ranks. So, learning to read slightly between the lines and understanding these styles can lead you to find sort of other shares a lot more acceptable for your investing appetite. What I tend to do is question shares that only have one strong factor. These tend to be very losing styles. A lot of people will misinterpret the value rank, and when they see the value rank as being very, very high, they often think that that stock is good value. But a high value rank, as we'll see, can be a value trap. So when there's only one strong factor, I tend to personally instantly discard it. If I'm a holder, I might use a bit more judgment, but I will personally never purchase shares that only have one strong factor, quality, value, or momentum. So I'm often asked, what are the kind of decision-making rules of thumb? I'll be talking a little bit about the crossover ranks today, because while you can screen for the value rank, the quality rank, and the momentum rank, we've got some two-factor, what we call the crossover ranks, which blend value and momentum. So rather than necessarily screening for a stock which might have strong value and strong momentum and using two rules in the screener, I might prefer to use the value and momentum rank, which is we call the VM rank. And if this is a little bit, if you don't know what I'm talking about, I'll show you in the screener. But essentially the VM rank finds shares that have generally good value and good momentum. So I might use these kind of scores: VM rank greater than 80, QM rank greater than 80, QV rank greater than 80. And when I'm looking at a stock report, a lot of people say to me, I can't find very many shares that have a quality rank greater than 90, a value rank greater than 90, and a momentum rank greater than 90. And I said, yes, that's probably going to be very rare. You might find less than 10 shares in the market in any one sort of country zone that actually have that kind of profile. So personally, when I'm looking at a stock report, I will look for the average of a couple of factors to be quite strong, and instead of having a very, very harsh cutoff in my mind. Generally, when I'm investing in a winning style of share, I'm looking for companies that score in the top quintile, so the top 20% of the market, because factor theory and factor investing theory from academia and from practitioners in hedge funds, they will generally invest in broad baskets of shares that score very highly in the top 10% or 20% of the market, for factors that are being targeted. So I hope that's kind of clear. And as I said, I will send this to you as a PDF. Just one thing before I go on into a bit more detail is to mind the correlations between ranks. So a key point is that quality and momentum have a tendency to be positively correlated. What this means is that high quality shares often have quite strong momentum because the market isn't generally that dumb. It does tend to bid up good quality shares. So they tend to move together. And this can have some implications when you're screening for styles because, for example, it can be very hard to find contrarian shares with very, very low momentum. I'll explain this when I come to look at that style a little bit later. But whereas in the contrary, value and momentum can be negatively correlated. And if you think about it, if something becomes very cheap, in other words, the value gets very high, momentum tends to be very low because the shares tend to sell off. So as a share tends to sell off, momentum drops, but value rises. So they can be negatively correlated. So bearing these things in mind can help with screening. It's a bit more advanced, that idea, but I will try and explain in some screens to come. Okay. I was just explaining the stock rank crossovers, which I like to use these ranks quite a bit, and they're quite useful when screening. So a lot of the slides that we're going to see, you might see some of these combinations. Generally, when I'm looking for what we might classify as super stocks, a very, very high stock rank on its own. But if I'm looking for a high flyer, as you can see, it's got very high quality, very high momentum. Therefore, I will use the QM rank. So if you're in any doubt of which crossover rank to use, just look at this mnemonic in the brochure, in the guide, and you can see the Q and M and think QM rank. I'll use the QM rank to try and find high flyers. And I'll often, look for a lower value rank when I'm looking for high flyers because high flying stocks tend to be very expensive. And I'll show you some examples of this as we come to them. Similarly, turnaround, VM rank, Contrarian, QV, QV rank. So it's quite straightforward once you sort of get your mind around these ideas. So look, what I want to do now is I want to go into a style focus. I'm going to go over each of the 4 winning styles in a little bit more detail. Now, we actually kind of came to this sort of realization of this taxonomy of stock ranks from because I was always a big fan of Peter Lynch's book, which is no, great. I'm live and I've completely forgotten the name of his book. What's his name? One Up on Wall Street. There you go. And he always had a taxonomy of what he called, of what were winning sort of stocks in the market. And so, we kind of like riffed on that idea, and because what falls out of the stock ranks are some very, very well-known types of investing style. The super stock style actually comes from, as we'll see, from a Robert Haugen book, but contrarianism is very famous. Warren Buffett, Joel Greenblatt, turnaround investing. Lots of people, especially in the UK, markets like the UK, turnaround investing can be very successful. And high flying investing, which is sometimes called, extreme growth investing. These are very, very popular and well-known styles. I think the important thing is to always think and look at these styles and think what type really fits your own investing psychology. If you're really not someone who's comfortable with momentum investing, you're much more naturally going to be a contrarian investor. If you're someone who's very comfortable with momentum and really believes in that factor, you might be very comfortable using a sort of high flyer strategy. I'll try and get a thread going on the website after this where we can discuss some of these ideas. Okay, moving on first to super stocks. On each of these pages, you will find a little link here, which links to an article that either Ben or I has written, which goes into a lot more detail on these ideas. So that's a link to Ben's super stock article. So I do recommend reading them because you'll get a lot more information than I can possibly cover in this webinar. So a super stock tends to be high quality, high value, high momentum. The ranks will be high across the board. In other words, it's a good, cheap, and strong share. But one of the things about these shares is they're not. We call them super stocks because it's a classification given by a very famous professor called Robert Haugen, who is now sadly not with us. He died a few years ago, but massively influential to the work that we do at Stockopedia. He called this a dream profile. It's the profile of a stock you'd love to own. He'll call this the profile of a super stock. And so we lifted this idea and this terminology directly from Robert Haugen. And the academics have been looking at quality, value, momentum for decades and found a sort of persistent outperformance to these ideas. Robert Haugen, in his book, he said, when given a choice between investing in these 2 profiles, which would you choose? Would you choose a high risk, low profitability, high price company with negative momentum? Or would you choose a low risk, high profitability, low price, positive momentum share? It's pretty obvious which one people are going to choose. They'd rather own cheap, good quality shares that have some momentum behind them. So it's really surprising that people don't. My theory on this is that people, there is a sort of psychology that acts against buying these kinds of shares because nobody likes buying problem shares, which tend to be cheap. Nobody likes buying good shares, which are often boring. People are much more interested in excitement and gambling in the stock market. And nobody likes buying strong or leading shares because it's scary buying shares at new highs. But what Haugen found is that there was this persistent outperformance of these kind of super stocks, which he modeled up in this green line here. And he found his backtests over decades where he found extremely strong performance, and he advised institutions for a very long time through his company. Our own model of this, it's a simple model looking at the highest decile shares according to the stock rank on Stockopedia. In the UK market, we found a very, very strong outperformance of 72% over the last 3 years, a 72% performance without dividends, which has been very strong. And obviously everybody using these ranks on the site have tended to do well in the UK market the last couple of years. Now, what I wanted to do is just quickly flick through to the site and show some of the, and I will share these links in the presentation. These are just stock screens set up, which allow me to go and find some shares which are classified for these profiles. One of the simplest ways to find the very highest ranking stocks, or what we might call super stocks on Stockopedia, is in the StockRanks portal. So you can just go up to the StockRanks portal, click on, and the default ranks the market by descending stock rank. I've been into that in other webinars, so I won't get caught up there. I just wanted to show you a little bit about screening for these shares, because when we're looking at the styles, it's a bit more important to go into a bit more detail. Obviously, if you can, some people like to use a lot of filters. Personally, I don't like looking at microcaps, although a lot of people do very, very well at investing in microcaps. So I personally like using a market cap filter of greater than 20 or 50 million pounds when I'm investing in these sort of shares. And I will often just sort by the stock rank descending. And if you do that, you can find that there are a variety. You tend to find a sort of trend, actually, which these stocks tend to be good quality, good momentum, and often the value can be a little bit more pushed. So the value rank can be a fair bit lower. And in this list, you can see a lot of shares which we've talked about as super stocks over the last few years. I'm actually just looking at the UK at the moment, but I will look at some American stocks later. Here's Dark Group, which is a classic example of a super stock profile. It's exactly the kind of share that nobody wanted to own, and has been ranked very highly for years now. I mean, right at the beginning of the stock ranks, it was one of the most highest ranked shares on Stockopedia, and the stock has just gone up and up and up. It first started qualifying on the screen of screens back here at about £1 and is now at £6.50. And this is an airline company, does chartered flights and etc. And it's the kind of share that nobody's really liked buying or owning, and it's just kept powering on. And that's what I mean about this profile of shares sometimes being uncomfortable for people to buy, because they've never liked owning shares. People don't like owning shares at new highs in uncomfortable industries. Warren Buffett has always said, how do you make a millionaire? Start as a billionaire and buy an airline. So anyway, there you go. So I will share these links to these stock screens, and you can dig around on the numbers more and dig around on the filters as you wish. Some people like to add in a cutoff to try and find higher ranking shares for quality, value, momentum across the board, and you can easily do that. Add that in, and and you can play with these cutoffs to find whatever narrow universe of shares you want. So when I apply those cutoffs, I only find 40 shares in the UK market. So going to my next, I want to just quickly skip back now, because I talk about those kind of shares a lot. One of the things somebody asked me is where do these kind of shares go next? And so I've added this slide in here to talk about transitions between styles, which I think is quite important. A super stock, this kind of ideal profile of a share, one thing is going to happen to these shares. Okay, often they're going to jump. One of these factors is going to jump, or two might jump. So naturally, if you think about one of these factors changing, it can move to one of three other profiles. So often you find these super stocks, what will happen is if the market likes them, they might get more expensive, in which case they might move up to a kind of high flyer status. If they take a tumble, you might move to the contrarian status. And if they start, the company starts deteriorating in terms of its profile, the quality rank might drop. And I'll show you this transition slide for each of these styles because it's quite illustrative. If you want to read up a little bit more on this style of investing, there's a couple of links here. I will share them with you, send them out. But these are slightly more academic readings than the other ones. You could argue that, for example, Robbie Burns' naked trader strategy it looks for good quality, good value, good momentum shares. Same Jim Slater's Zulu principle. But the slightly more academic readings are very good on this stuff. So I'm going to move on, and I want to talk a little bit about high flyers. It's one of my favorite types of share in the market. These really are the kind of stocks which people want to own the most in the market, but they're often very scared to buy them because they can be frighteningly expensive. These are high quality, high momentum shares, but very, very expensive. So they're good, strong shares. You can read up more again at that link. There are certain style advocates. Some people have done exceedingly well just buying expensive shares that are very, very strong, growing fast, high quality, high momentum. Some of my favorite quotes are on this slide. Bill O'Neill, great inspiration to our work again. He's said it seldom pays to invest in laggard stocks. Value investors might disagree, but his entire career and wealth is built on not buying value stocks. So even if stocks look tantalizingly cheap, look for and confine your purchases to market leaders. Some people will find this strategy very attractive. And I know there are, long-time StockBeater subscribers like Phil Hoffer, who's very active on the boards, who's done extremely well using this strategy. And I used to use it almost out and out as my own strategy in the market. So, when you're, and this, I've got a few performance slides here, which were done on a sort of 25 stock backtest using our archive data, using some parameters, and the high flyer profile has done very well. And what was particularly interesting about my test on this is that I actually specifically screened for some of the most expensive shares in the market, because I wanted to prove to value investors you can do well buying more expensive shares. It just can be a bit more of a hairy ride. So let me flick back to the site and show you how we might screen for these high flyers. So I'm screening actually in this version for a QM rank. So if you type in QM rank in the screener, greater than 90, that's the top 10% by quality and momentum. And then actually specifically looking for expensive shares. I know it sounds really counterintuitive, but just, this is what I did in the back test. Value rank less than 33, and also looking for higher market cap. And you get a list of shares, which makes for really interesting reading, because if you look at this column, the value rank, very, very expensive shares, low value ranks. But you get some of the best, what have been the best performers in the market. I'm looking at the UK, but I'll switch to America in a minute. For example, Rightmove, it's got a monopoly in sort of online, housing market. ASOS, Just Eat, WH Smith, Domino's Pizza. These are, some of the most sort of admired companies in the UK, but often they're at nosebleed valuations. And in aggregate, they do tend to outperform, but sometimes they can correct really, really viciously. And that's one of the transitions of high flyers, is they can become falling stars. I'll explain that a little bit more. And that definitely happened to stocks like ASOS. I'm pretty sure we can find Boohoo on this list, which I will talk about in a little bit more detail later. Boohoo is a classic example of a share that became a falling star. And you can see on this little chart that the share price collapsed when sentiment went against it. But I will look at this in a lot more detail shortly, but it has become, again, a high flyer, and it's really the stats now totally backing up what Paul Scott has been saying in the discussion area of the site. And actually, some of the kind of shares that, if I go and focus on the American market, I'm not sure if I can find. Oh, well, this is a very good example. You have got, for example, Facebook and Amazon, two of the biggest, highest ranked high flyers in the market right now. If we go and click and look at Amazon, Amazon up here, and you look at the rank area in the top right, quality rank 99, momentum rank 99. It's got a blazing QM rank. Value rank is not, it's very low. This is a classic fingerprint of a high flyer. And as you can see, the share price is absolutely rocketing at the same time. One of my favorites, and this is one of the things that StockBeater has done for my own investing. I had a huge bias against Facebook when it floated, and I blogged about it. And yes, it was overpriced then and it fell. But when they actually sorted out their mobile strategy, it became one of the highest QM ranks stocks in the market. And as again, you can see quality and momentum 99.99, value rank 11. It's never looked back, and it keeps storming to newer highs. One of the cool things on the stock reports is if you look at the print button, you can actually go back in time. So if we go back and look, back at this company, I haven't actually prepped this, but you can bring up the stock report from historical stock report, and with any luck, this will back up what I'm saying. Can sometimes take a little bit of a moment to fetch it from the archives. With any luck, this will load. This is the problem with webinars, then it doesn't load and I can't. But I'll come back to that in a moment. But if you are on a stock report, you can load the old stock reports that we have archived using this feature, and have a look at the ranks historically, and it always makes for fascinating reading. with any luck, that'll come there. You can see this is one taken from beginning of 2015. High quality, high momentum, but only a stock rank of 66. Now, people who can read the styles and read the high flyer style will understand that that has a QM rank of somewhere around 85 or 90, and this is a particularly sort of strong investment case behind it. Anyway, that is a little bit on high flyers. I wanted to look a little bit at Boo before I move on, because Boohoo, as I know for our UK subscribers, and we've got a big UK subscriber contingent, being a British company, I just wanted to show a little thing here, because and show how this data can really back up investment decision making. What happened here is that this stock fell and had terrible sentiment sort of beginning of last year. Paul Scott banged the table and said, buy, 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 buy. Now, he's a genius. Paul Scott's a genius and accountant. He has so much experience in the retail sector. He knew this was undervalued then. Personally, I've given up doing reading between the lines on accounts, and I'm purely quant now. So, the question is, what style of stock was it then? Well, it was basically, if we look right back to, when was it, Jan 15, and we have a little look back then, we'll find that this had the kind of profile of what we call a falling star. So if you can see up in this top right corner, high quality business, but very low value, very low momentum, and trending against. I wouldn't personally give it the second thought, so I wouldn't. But as the share price started to recover, you started to see this, really change fortunes. And if we look at it, maybe even sort of a few months ago, 6 months ago, I'm pretty sure this will back up what I'm talking about. You start seeing in about November last year, the quality and the momentum scores recovering. And this has now, they've kept recovering to the point where you can actually sort of really see what a high QM stock this is. So, when both these scores actually went above 80, the share has now gone 40% higher. And all during that time, so many people have been selling because they thought it was expensive. But if you understand to read between the lines and understand the styles, it can give one more confidence in holding shares longer as they move through different styles. So anyway, I think that's quite interesting. I'm going to move back to the presentation, and I knew this was going to happen because I could go on about this for about a day. If you want to have more further reading on this this style, I highly recommend William O'Neill's How to Make Money in Stocks. That is one of the most foundational books I ever read on the stock market, and it really purged me of my unwillingness to buy shares that are expensive. I can't recommend it more. Now, where does a high flyer go next? To be honest, even though there's three sort of theoretical transitions that can go on here, what you tend to find is that high flyers I find more often than not, high flyers tend to become falling stars. Why? It comes down to momentum and earnings momentum. What one finds is one of the earliest signals that high flyer is falling out of bed is either falling price or brokers cutting their numbers. Assos was a prime example. We just looked at Boohoo. Assos in the UK, one of the great glamour stocks. It did so well in the market for so many years and was another classic high flyer. But as soon as that momentum turned, it really was look out below. So if we go and zoom in a bit on the stock report to this period, you'll get more of a sense of what I'm saying. The stock had a perfect high flyer profile all the way up here, but then the brokers started cutting their numbers and it was look out below. Since then, the stock has been recovering, and as we can see, has much more of a high flyer profile now. So when you're investing in high flyers, one has to keep stop losses or a good eye on what the market sentiment is like. I got to move on. Let's move on. Okay, Contrarian. Now, I presume there's a lot of value investors listening. This is possibly one of the most classic and well-known styles of investing. Buying good quality, good value shares that are suffering from temporary slumps in fortune. You can think of these as good, cheap shares with weak share prices or deteriorating sentiment. Contrarianism has obviously been made famous by so many investors, and it comes so naturally to many, many people. Anybody who's uncomfortable with momentum will fall into the classic contrarian category. Some of my favorite quotes of contrarians are Warren Buffett. I think he said, when it comes to socks or stocks, I like buying quality merchandise when it's been marked down. Joel Greenblatt, the famous fund manager, buying good businesses at bargain prices is the secret to making lots of money. We've actually found that this is quite a crowded strategy. You find that there actually tend to be a lot more people who hunt for good quality value shares. There are almost every fund manager in the world is looking for the same kind of shares. We found they do tend to outperform, but maybe not as much as when using momentum as a factor too. Sorry, you can see I actually was doing these slides this morning, and as I go through them, I can see some mistakes. When you're looking for contrarian shares, you're looking for a high QV rank. You're looking for good quality, good value shares, or a low and possibly low momentum rank. But as I said, it's often very difficult to find, as momentum and quality are correlated, high QV ranks, you tend to be a bit more willing to you don't just want to find shares that are really suffering from poor momentum, because you can find traps. Let me just go and dig in around the stock screener to show you some of these kind of shares. Let me go and look at my contrarian list here. And in this list, which you can see, I've used a QV rank greater than 80, momentum rank less than 40, and also looking for market cap greater than 20. You can see some really great businesses that are perhaps suffering from slumps. There's Burberry. We all know about this company. It used to be very, very highly prized. It's now becoming much more of a value share. It used to be so expensive, and it's becoming, a lot more reasonably valued. William Hill, the bookmaker. Indivior, another share, very contrarian. Sports Direct. As you look at the hover chart, you can see a lot of these have had recent slumps in fortune. So you look at a list like this and you think, crikey, that is a contrarian list. Again, psychologically, some of these kinds of shares can be awkward to buy or own. Anyways, it's all quite interesting. You can dig around in there. Have a good look. I'm going to crank straight on because I do have a lot to get through. We'll answer questions at the end. There's so much reading on contrarianism. I can't. Some of my favorite books are in this list. If you're a novice, The Little Book That Beats the Market is terrific. It's 150 pages. It's designed. Joel Greenblatt wrote it, I think, so that his son could understand what he did as a hedge fund manager. And he's a great educator and a very good writer. And if you want to take it a bit more advanced, or you want to learn about Warren Buffett, these are really good strategies. All these books, we've got some of the strategies modeled in the stock screener on Stockopedia, but I don't have any time to go into that. Where do contrarian shares go next? Well, one of the big worries for contrarian shares is they can move into the value trap territory. We will come to value traps later. It's the biggest risk for contrarian investors. Are you sure it's a good quality business? If it's not, it can become a trap. That's pretty nasty. If the momentum picks up again, yes, you could be back in super stock territory if it's got very cheap and it stays good value. Once again, 3 clear transitions. Right, rattling straight on. Turnarounds. This is one of my favorite styles. Again, I'm probably saying favorite about everything, but it's I really am a big fan of value and momentum. I think it's one of the things about value and momentum is they seem so contrary. They are contrary to each other as factors. If something gets cheap, momentum tends to go against it, but things can get very cheap. And it's when things are very cheap and the momentum starts recovering that you find turnaround situations, and they can be super profitable. Again, there's a blog there that can be read up on if you want more detail on this style. These are cheap, strong shares that are often suffering from, they might even not be profitable at the moment. They might be, they often can look quite poor quality, because what happens is brokers can often start upping their numbers in advance of profitability happening. So, for example, a lot of the house builders got in all kinds of trouble way back. And in that brochure, so keep calling it brochures, the guide, the downloadable guide, there is actually a whole section on Barrett Developments and talks about its journey through the stock ranks. It moved from value trap to turnaround to super stock, and now is a contrarian. So, often this is one of the points where you actually find stocks become super stocks going through this turnaround phase. It's one of the common routes. Style advocates. You often find that the numbers guys really like value momentum. James O'Shaughnessy, another huge inspiration to our work at Stockopedia. He's done so much testing. I recommend his book, What Works on Wall Street, as a purchase. He found that trending value momentum is the best performing strategy since 1963. And Toby Moskowitz, whose paper I link to in a moment, did this amazing paper called Value and Momentum Everywhere. And he advocates value momentum in not only all stocks, but in all asset classes. These two twin, slightly contrary factors of value and momentum just being so powerful. Turnarounds, again, really strong performance in the stock market. And when screening, I'd be looking for a high VM rank. I would be willing to look at any quality rank when I'm looking for these kind of turnaround shares. I might not specifically screen for a low quality rank. So if we go again to the screener, I can show you some of these kinds of shares. VM rank greater than 80 or 90. Let's make it a little bit more strict. And a quality rank less than 60. And let's have a look. And well, there's Sainsbury's, big British supermarket chain. A lot of the supermarkets in the UK have been really struggling against the very low cost Aldi and Lidl competitors that have come over from Europe. And you find a lot of there are a lot of turnaround plans in place with these companies. So particularly interesting. One of the stocks that I think was a great hit on Stockopedia was Trinity Mirror. Paul Scott found it, and it was the classic example of a share that was a turnaround a few years ago. And he started buying it at these low levels here, if I can zoom in, because what happened is it collapsed. And the share price, this was looked like a terrible value trap, but it started getting much improved sentiment, and the VM rank really took off about here, and there was a fantastic multi-bagger to be found. You can see from a price of 25, almost 10 bagged. So this turnarounds can be a great source of 10 baggers, but often in this area, Trinity Mirror is a newspaper publisher. It's not a great place to be in business, and as you can see, there are plenty of reasons why you might not like it. Now it's actually looking much more like a value trap again, because you can see a high value but low quality and low momentum. So this shows you some of the transitions again that these kinds of shares will move through. Again, a turnaround can move back to a value trap if its business doesn't really significantly improve. You have to be careful with turnarounds because they can be quite dangerous. And that's why I always advocate taking a lot of diversification when you're investing in these kinds of plays. For more information, have a look at that book, What Works on Wall Street. If you can't type this down, I'll send this PDF to you straight after this presentation, and a really terrific paper called Value and Momentum Everywhere for the geeks. Okay, we've had a bit of fun looking at some contrarian shares and turnarounds and the winning styles, but now we can really have some fun looking at the losing styles. And I hope I'm not losing any of you as I crank through this, because I knew this was going to go on for quite a while. We're already at 1:14. I'll try and be brief, not take up too much of your time. I'm sure lots of you got work to get back to. Really, this should be like a sort of an all-day seminar, because there's so much we can dig into. These 4 losing styles, like I said, often the trap zone is momentum traps, value traps, and falling stars. They often are traps for investors because they can look very attractive from some kind of perspective. And what you find in all of these classic losing styles is that these stocks tend to have some kind of story behind them, why they will recover, or why they are still a great investment, or why you should believe. And stories are one of the things that get us into the most trouble as investors. We were not designed for investing. Our brains are designed to sit around campfires and tell stories to each other. We evolved this way. Unfortunately, story-based investing is an expensive mistake in the market. One must make sure that, when investing, we're always exposed to what genuinely pays off, which is, these factors. So firstly, let me just dive into what I call momentum traps. Just some key quotes here from James O'Shaughnessy, but James Montier, one of my favorite writers. He's not writing so much anymore, but he wrote some great books. The Little Book of Behavioral Investing is one of my favorite books. Of all the dangers that investors face, perhaps none is more seductive than the siren song of stories. We will abandon evidence in favor of a good story. And momentum traps are the classic kind of profile of shares that have a great story and real momentum behind them, because a lot of people believe. Unfortunately, momentum traps have tended to do very badly. So these shares, they tend to be, as I was saying, expensive and and pre-profitability. So low value, low quality, because they tend to be sort of story stocks, future value, but they often have share prices that are rocketing. And if you take them on aggregate, they do really, really badly. So our performance measures here have looked at sort of 25 stock portfolios of momentum traps and shown that they don't beat the market. They do very badly and don't tend to make money. So these expensive junk stocks, but with very strong momentum, is the rule of thumb. Let me just go into the screener and show you some of these shares. I'm just trying to think of a few offhand. I mean, there's so many of them. I can show you, for example, stocks like Nanoco. I'm sure a lot of people probably own this share, but this is the classic kind of profile of had a classic profile of a momentum trap right back here. 2013, really, really strong momentum, but very expensive. Rocketed up. I haven't checked this, so this might not back up my. This might not back me up when I look at the old report, but it very well might do. No, that was actually after it already started falling. But you find that these shares tend to have very high momentum for a while, but then often the story isn't fulfilled. The company has to raise more money. They keep pushing back their prospects, and investors are disappointed. And that's happened again and again. Blur Group was another example. Monetize. I'm trying to think of some others, but momentum traps can be really dangerous. So if I can look at the screen of momentum traps that I have here, obviously a classic indicator is a momentum rank that's high, greater than say 60 or 80. Let me just build up a kind of profile, because I haven't actually done this. QV rank. A QV rank of say less than 40 and a momentum rank greater than 80. And in fact, I'll add in a market cap rule here as well. Market cap, let's say greater than 50 million sterling. I mean, to be honest, you can generally push this a lot higher. And you find 90 stocks there. And, in here you tend to find, lots of kind of story stocks that can be quite dangerous. Anyways, I'm not going to spend too much time digging around on here. You can push these kind of factors a lot further and see what comes out with this kind of profile. I mean, Glaxo there is actually for some reason coming up at the top. But often you find there's sort of AO World. You find all kinds of shares in there. So, have a good dig around and see what you can see. Often you find some of the big story stocks in the market. Okay, we're going to move on, and I'm going to move straight on to value traps. Value traps are one of the profiles that so many value investors get sucked into. It's when a stock just looks super cheap, and so cheap that you can't ignore it. But unfortunately, often the market's against it, and it just doesn't recover. There is so much been written about value traps. Seth Klarman, who should know because he's a billionaire, and he invests a lot in very contrarian shares, but the possibility of sustained decreases in business value is a dagger at the heart of value investing. As a value investor, you must try and avoid value traps. So if you see a profile of share which is got a very high value rank, but very low quality momentum ranks, be warned. It's one of the most expensive mistakes you can make. Our measure here in our backtest showed very, very, very poor performance. And flicking back to the screener, I can show you some of these stocks. You tend to find, in the UK, we found a lot of value traps in, for example, I don't have it actually on my list. So I'm going to have to build it. which is always good fun. I will just create a new screen and I'll call this value traps. I must have deleted it earlier. But a value trap will tend to have a value rank that's very high, let's say 90 plus. And it will often have quality and momentum quite low. So let's have a look just for let's say less than 30 and see what comes out in the wash. Right, I mean, okay, like we were saying, Trinity Mirror, we were just looking at it, possibly a value trap now. And, often you find in here a lot of business models that just aren't working. So one has to be careful in value traps. Personally, I think this sort of area of the market is best investigated by people that are trained accountants, really know what they're doing. If you're a part-time investor, my general feeling on it is you should just avoid these kind of shares. I know a lot of investors have invested in, I know a lot of private investors have invested in stocks like Real Good Food. And, there's a possibility, I know nothing about it anymore, but I have seen an investor presentation of it. But there's a possibility this has a kind of value trap profile. So I'm going to move again swiftly on. Remember that the transition from value traps, they can become sucker stocks quite quickly. And if they move out of value trap territory, they can become turnarounds or contrarian sort of profile shares. Okay, moving on. Falling stars. Falling stars are actually a fascinating area, and I won't spend too much time because we already looked at these in the context of high flyers, and I always find that high flyers and falling stars can be quite coupled. If for example Facebook fell out of bed, which at the moment it's got so much momentum, but if the momentum rank suddenly just fell, if sentiment turned against the stock, if there was some kind of competition that really took its advertising revenue, this could fall a long way. And that's the kind of thing we've seen in the UK, which these shares like ASOS and Boohoo historically, that then eventually do recover. So you find there's this dynamic between high flyer, falling star, and often recovering to high flyer again. So, you're looking at a profile with, very high quality share, but momentum turning against it. Which is why so many investors, they say, use stop losses when you're investing in these kind of shares. Mark Minervini, expose your portfolio to the best stocks the market has to offer and cut your losses very quickly when you're wrong. And I love this quote from Jim Slater. If a company's story changes for the worse to a material extent, I immediately sell. Speed is of the essence. You want to be first in the queue of disappointed enthusiasts. And I can guarantee you for stocks like ASOS, there were so many enthusiasts that kept holding the share for a very long time while the stock went nowhere. People fall in love with their stocks. You've got to be careful. And falling stars, again, you can see in our list, I've not got a very great profile there in terms of returns. Now, I've been screening all of these shares as we go along. Where is the falling stars? There we go. Okay, let's have a look at this from the potential of, I want to make sure that we're looking at, quality rank higher than 80. So let's have a look at a few of these. Often you can find shares. Often there can be a bit of overlap when you're using these screens. So often you will find, unless you use very exclusionary criteria versus the high flyer screen, you might find the same kind of shares showing up. So can be quite good to be quite brutal on your screening criteria. Okay, here you go. Stocks like ARM are coming up in falling star zone, and some of these are very, very high quality businesses that could well recover, etc. So anyway, I hope that's useful. We've got one profile left, and I'm sure you're all desperate to leave by now. As I said, falling stars can become sucker stocks. They often move back to that high flyer zone. I find less frequently they move into the contrarian zone. Okay, sucker stocks. Now, I've always had a lot of fun at the expense of sucker stocks. They just are, there are so many shares in the market that are sucker stocks, which is why I often use a very broad screening criteria to look at them. The classic is looking at the most discussed stocks in the market. This is a bubble chart which shows quality on one axis, value on the other. and all the most discussion tends to happen on expensive junk. Never the kind of shares that tend to actually outperform the market. So what does that tell us? It tells us that story stocks are massively alluring for investors. They want to believe in stories. Focusing on the cold hard facts, soundly based in real numbers, is likely to be the best defense against the siren song of stories. Just be careful. Whenever you see a stock with this kind of low ranks across the board, be highly wary. The performance is dire, dismal, of this basket of shares in general. You might get lucky, punk, as some might say, but it's if you find your portfolios generally all in these kind of shares, be very wary. It tends to be a losing play, and the thing about sucker stocks is they can only go from really bad to pretty bad. The transitions tend to be pretty poor. We always have a bit of fun in the stock reader office when we screen for sucker stocks. You can do you can either use the overall stock rank and just look for a very low rank across the board, or you can look for quality, value, and momentum ranks all very low. And you get a lot of kind of usual suspects. I mean, there are a lot of sucker stocks have been a lot of sucker stocks in banking, in oil and mining, etc. A lot of these sort of companies are quite sort of have been quite nasty plays. There, as I said, Nanoco, Avanti Communications. A great friend of mine really tried to convince me to buy this. I owned some before it was spun off from Avanti Screen Media. But Avanti Communications has been a dismal play for investors. And one of the things that happens with these kind of shares is they because they're always so unprofitable. Avanti is a classic example. Still got a market cap of 100 million, really low across the board, value, quality, and momentum. Often they have a short selling screen they're coming up for, but often they just never make any money. They're jam tomorrow stocks, so they keep losing money because they say they're investing for the future, and they normally are. But what one always finds is that they have to keep raising capital. So one of my favorite lines in the financial summary is to go and look at the average shares. And if you look at that line, you often find it's going up and up and up and up every year. And that shows you that the company keeps having to issue new shares. It keeps having to raise money. What do companies that don't make profits have to do? If they're consistently unprofitable, they'll run out of cash. Hence, they have to sell more shares, dilute your stake. It's not a pretty ending. And that's why baskets of sucker stocks tend to do so badly. Why private investors continue to buy these shares is beyond me, but I know it's to do with our behavioral biases and the allure of a story. So again, if you see these kind of stocks in your portfolio, okay, it might be okay to own one or two if you have 25 shares in your stock portfolio. But if you own 10, just be warned. And that's my whiz through all the styles. So to conclude, and it's been an hour. If you're still with me, I've still got most of you online. I'm thrilled. This is as I said, the sort of I Ching of the stock market. They're rules of thumb. They're not hard edges. One can often see the genesis of another style from as things are moving through the styles. Stocks often will come and make trips through these styles, through those transitions. Like I said, Barrett Developments, some of the house builders, they were value traps, and then they moved through turnaround status. They became super stocks, and then as the prices sort of normalized, they've become, some of them arguably, one could say, are moving to contrarian plays again. So be very conscious of the transitions between styles. Personally, this is the thing in order to lower transaction costs in my own portfolio, I will be willing to let one of the ranks slip. So I don't like holding shares when they fall down into these losing styles. But when a stock moves, for example, one of the factors comes off a lot, I'm often very comfortable. So if something becomes a sort of QVM share becomes very, very popular, I know the high flying style can do very well in the market. I'm very happy to continue to hold. So that's a key point. And often one can be a bit looser if one uses the overall stock rank on a purchase criteria. One can often be a bit looser on the exit than you are on the entry criteria. So as I said earlier, high flyers can often have much lower stock ranks, but one can continue holding them because of the QM rank. Again, this is an important slide. One must find the style that best fits one's own psychology. Each of these things and each of those winning styles throws up difficulties for investors. You know, the high flying style is not suited to somebody who gets very, very nervous about momentum changing, who's very nervous about holding expensive shares. Some people are just so uncomfortable about doing it. Others, you know, really, really can't bear the idea of owning shares that have got temporary troubles. So contrarianism is not a good investing strategy for those kind of people. So try and think about your own investing and finding styles that fit. Remember those rule of thumb slides, seeking 2 or 3 factors before purchase consideration. And personally, I always question shares that only have one strong factor. And one of the regular things that people say, regularly people will misinterpret the value rank. And because they'll see the value rank and they'll think, oh, that stock's good value. The value rank is defined as a pure measure of cheapness. And personally, I will only use the value rank if backed up with either the quality rank or the momentum rank, because then I know it becomes one of those winning styles, turnaround or contrarian. So, you know, you just don't want to be mucking around with shares that are value trapped, in my personal opinion. So, I mean, that pretty much sums up my presentation. It's pretty much bang on an hour. I'm going to try and answer a few questions. Anybody who, if you've suffered through this long, well done. I hope I hasn't been punishing because this or grueling. I'm sure you will have got some good value out of this. Anyways, so let me have a quick look through the questions, and I'll try and answer them through support later if I can't answer them now. Let me have a little look. Yeah, I mean, this is a good question. Stock examples used cover a time frame of a rising market. How will the 4 positive archetypes work in a falling market? The truth is that all styles are correlated with the overall market, and you know how one's portfolio does in a drawdown. Often, if you're in a momentum portfolio, you're often going to suffer just as hard, or even harder in a drawdown than the overall market. When markets are rising, momentum will do a lot better, but it can suffer more strongly than the market in a drawdown. That is often seen. People that are very people that don't want to or would rather avoid harder drawdowns in the market are always should always look for higher quality shares, and especially looking at lower volatility shares. Lower volatility shares tend to perform. They tend to draw down less than the market. So one can use beta in the screener to look for lower volatility shares. I mean, stocks like Unilever don't tend to sort of, which are consumer goods and very high quality businesses, have tended not to draw down as bad as the market. Let me just go back to the screener and show you a way that possibly one could counter drawdowns. If I try and find a tag such as I mean, okay, let's look at high flyers. You know, it's got a momentum factor in it. But if you were to just use and enter the beta is low beta shares tend to draw down less than the market, and the average beta is about 1. Beta of 1 means that a stock tends to move in line with the market. A beta of more than 1 means it moves more. Whereas a beta of less than 1 means that it moves less. So, you know, you can add beta to a screen and start, and you can see it here. So yes, like I was saying, Reckitt Benckiser is another sort of Unilever kind of share. And you can find sort of lower volatility sets of shares, which in theory should draw down less than the market in drawdowns. But one has to be careful. I wouldn't probably, anyway, that's, I hope, answers that question. The other thing to do is to use hedging strategies to reduce the impact of the market, but that's for a different topic for a different webinar. How do you find the screener screens I'm using? I will add them to the presentation that I will send out after this. They're not actually on the site as a feature, but I will send them to everybody on this, and I'll try and put a blog up too. Don't be brief. I'm enjoying it. I've only got the decorating to go back to. Okay, Nigel. Um, are there any indicators that would tell of a rise or fall in a stock's price in future? I wish I had that crystal ball. I really do. I tend to, over my kind of career in markets, I've gravitated towards the idea that I can't quite predict the market. I used to have great success with breakout shares, but I found it very, very high admin. In other words, shares that are breaking out technically from a sound base. But nowadays I trust in these factors because it's much less administration for me on a personal basis. How can we identify stocks that are transitioning up the styles? Will there be ways to screen for QVM trends over time? Well, it's a great point. We do publish these things that we call deltas on the stock reports. With any luck, okay, if I go back and I show you here, Boohoo. Boohoo, you can see there's a little green arrow here, which if you hover over it, it says there's been an increase of 6 in quality rank over the last 30 days. And that's kicked the stock rank up a bit. If you go to ranks, hover over ranks, you go to stock rank movers, this link here, you can actually go and find shifts in the QM rank or which might help you spot these kind of trend changes. So if I was to go and look, I can use this and screen here for example, QM rank. If I want to look at, for say, stocks that might be becoming a high flyer, QM rank rising above, let's say, I don't know, 60 in the last week by, 5 ranks, and press submit. Here we go, and here's a list of some shares whose QM ranks are rising. Now, I'm not saying these are all going to be, high flyers, but and you might want to sort of muck around with the filters to try and sort of keep on top of this. But this is our kind of built-in screener for finding these kind of transitions. It's the delta isn't on stock, isn't in the screener at the moment. But that's a way that you could possibly find these kind of transitions. I mean, look, there's Pets at Home. It looks like it's been been languishing for some time, and something's obviously happened there that the stock price has rocketed up a bit. Momentum's increasing. So that's one way that I would do it. Okay, thanks a lot, guys. I'm getting some compliments. I've been setting a minimum quality rank score to try to avoid value traps. Is this a mistake? No. Don't misinterpret the slide. Value traps have low quality ranks. So to be honest, I like higher quality companies. So, you want to be setting using the quality rank as to cut out value traps is a really good idea. So, you can add this in any screen, creating a screen and say, the anti-value trap screen. You might say, okay, let's just start with a quality rank greater than, let's say, 55 as a base benchmark. And then you can add your other filters on top, whatever you like doing, whether you like looking for, you want to search for value shares of with a P of less than 10 if there are any. That's a way hopefully that gives some measure of protection against value traps. And I can see Drax there, which is actually my best performing New Year nap, which in the UK, which was which we picked for the New Year naps right at the bottom. It really looks so ugly as a business, and it's returned something like 30% since it was it put in the portfolio. And that quality measure really helps. And I'm not saying this is a super stock yet, but you can see that profile starting to emerge on Drax. Anyway, interesting. Thanks. That's a really good question. Okay, what movement should prompt to sell? Again, it all depends on personal circumstance and personal strategy. I can't. There are so many different selling techniques. Technically, some people use certain stock ranks as filters to trigger a sell. Some people use judgment. I tend to use sort of periodic rebalancing, which is more brutal on the exit. But I'm very happy to hold companies for longer as ranks migrate to reduce transaction costs. The one thing you've got to be careful of in the investing is keeping costs low. If you have a trigger like stock rank drops less than 95, one can find that it just creates so much churn in small caps that you end up sort of just generating a lot of cost. I mean, I think in my New Year Naps portfolio this year, I can't remember how many names were the same as last year, but it was about sort of 8 remained the same. The good thing about having momentum in a portfolio strategy is that the shares often the shares from 1 year, you'll still hold a lot of names the next year which were the same. The better names that have performed well, and that can be the way to sort of, even in a rebalancing strategy, to reduce some of the cost. Okay. Thanks, guys. I'm going to just do a last few questions before I let everybody go. Statistics we gave on super stocks and turnarounds do not mention time of exit or criteria for exit to achieve those results. Okay, what we did in those back tests, from memory, and actually on the chart, it's not entirely clear, but I will update those slides before sending them out to you. I actually used annual rebalancing on those strategies, except the super stock and sucker stock slides. So they were used annual rebalancing for the last sort of 3 years. But those performances only went up to about last October or November when we were blogging about them. I haven't updated them since. We are working on a back tester which can model these strategies a lot more up to date and in a more timely way, but it's going to be still months away. But yes, I used actually annual rebalancing on those strategies for that 25 stock portfolio. So it was just a pure, annual rebalancing. Some of the names were the same, but a lot of them were booted. Yes, I will send you a copy of the keynote slides. Hang on a minute. Okay. To my mind, the super stock may only go one way, have one way to go, down. But one of the winning styles, Contrarian turnaround, might have more upward potential through improvement in the flagging factor. Yes, well, that's another interesting idea. But no, I don't. One could say that, if something is exposed to quality, value, and momentum, it's going to lose its exposure to one of those factors over time. It definitely is. But that doesn't mean it's going to become less of a good prospect. As I said, and in fact, it's not only us, but high flyers. I know some other, I have seen, plenty backtest and live performance studies of these kind of styles over time. And, high flyers I've seen outperforming super stocks. I mean, in America at the moment, high flyers are way outperforming super stocks. So don't think that just because a stock doesn't have, loses exposure to one of these factors, it doesn't mean it's going to make it a worse prospect, which is why it's one mustn't be sort of blinkered, and that's why I say understanding this sort of array of styles is quite important. I mean, obviously, look, if you're in a high flyer and it becomes a super stock, what's actually really happened there? Well, either there's only one way it can go. The value rank has to normalize. So if the value rank starts going up, that means the stock's got cheaper, which probably means that super stock has hung around at the same price for a very, very long time. You could argue that, I don't know, I'm thinking like high flyers like ARM, which have consolidated for a long time, that may have happened. So, it's not necessarily true, or potentially the stock might have changed in a different direction. Okay, how is NAPS 2016 doing? I will be writing an update on it. They're flat, to be honest. They're flat. It's been a tough market. There's a lot of churn in the market. I've been wishing I had more time to write for the community, but we're building such a wonderful new product. I'm so consumed by it. But trying to do some of these webinars and things to keep things going. But I promise I will try and write up the NAPS for a semi-annual rebalance soon. But they are effectively flat to about 1% down at the moment, with Drax as the biggest winner. What's my view on Brexit? I don't do that kind of thing. I don't do stories. I'm not answering that question. Looking forward to a hedging strategy webinar and blog. Okay, I will do that because I had phenomenal results last year with my fully hedged StockRank strategy. Let me see. Okay. Oh, there's a question. Our sucker stock screen shows RBS and Standard Chartered at the top. Yes, they could be viewed as contrarian. They could be. I mean, you could say all kind of cheap shares are contrarian. Of course you could. It's just a label, but we're using it in a label from this sort of factor framework. So I'm not going to get caught up in those kind of arguments. Okay. Is high momentum such as RSI often viewed as an overbought signal? Yes, you can. A lot of people do trade smaller, slower sort of swing cycles. using RSI and MACD, etc. If you're a swing trader, you might. It all depends on time frames. I use momentum over a 1 year time frame, so I'm not really budged by sort of month to month transitions to overbought and oversold states. So I personally don't really go into that. I mean, the stocks that are on that genuinely, if you find the top 10 shares or top 25 shares that are just pure out and out best performance over the last 12 months, and you hold them again for another year, you tend to find they do that sort of portfolio. Pure momentum portfolio does very, very well. You tend to see mean reversion in momentum over longer time frames. So I think RSI and things are much more of a kind of short-term swing trader factor. Okay, let me see. Q probably won't move much between reporting dates. Yes, it's true. That's a good point in terms of what moves in between reporting dates. You tend to find that value and momentum move a lot more. Tom, who's sitting next to me, did a blog about this. You should look on the discussion stream. I think Tom, you were looking at Boohoo, weren't you? Yeah, we've been looking at Boohoo a lot. Really good. Here it is. It's about 4th in the discussion stream. And you can read that blog, and Tom's been experimenting with 3D visualizations of the stock ranks, which has been great fun. And he's put a sort of animated GIF in here. And generally, what did you find? You found over the course of the year, there was a big jump in quality rank when
a number of times. Every time results get released, basically, it leaps side to side very, very quickly.
Every time you see results come out, there can be big jumps in quality. And that's understandable because, the profitability might change a lot. And obviously, and also when results come out, you can see big jumps in value rank. If a stock jumps from losing money to earning money, making profits, the value rank can jump considerably because the value rank is backwards looking. So yes, momentum rank tends to move a lot more with price and also brokers when they slash or up their numbers, the momentum rank can jump. But yes, quality rank can be quite stable for longer periods of time. But obviously these are all relative to the rest of the market. So, they don't stay steady ever because the rest of the market might be reporting. And so relatively it can change. Okay. Would I buy Valiant? I'm not going to answer single stock questions. I don't genuinely. You can ask people like Paul Scott that. I think I'm coming to the end. Just going to flick through some more questions. No. May have to become a little less contrarian. I hope so. Okay, great. Thanks a lot, guys. I will need to collaborate for Indian stocks now. We do have the Indian stocks on the site now. We do have an Indian office, and I go there quite a lot. And huge fan of India, and the Indian guys in the office who make a lot of so much of the magic that goes on behind the scenes at Stockopedia. Are absolutely loving the new Indian site. So if you have any feedback about that, please do let me know. Ping me a. I will check out your blog, Gaurav. Great that you've got in touch, actually. Great. Okay, guys. Right, listen, thanks a lot. That was an hour and 20 minutes. It's more than I usually force you to listen through. If anybody hasn't signed up yet, we are doing some introductory offers. If you wanted to upgrade to an international plan, we're happy to honor these discounts if you're on this call. But we can only do these introductory rates because I promise you our prices are as low as feasibly possible, and we can't run at a loss. So current subscribers, I can't offer these discounts. But if somebody is just not sure and they would like to have a sort of entry level rate, please get in touch with us and we'll try and get you on an introductory rate. So anyway, thanks a lot for listening, and I hope this is useful. Really hope we can get some discussion going. So we'll try and knock out a blog maybe over the weekend and get back on that writing horse. So thanks a lot. Cheers for listening in. Take care.